The employment report on Friday showed 22,000 jobs put on the books, negative revisions to prior months. It was a bad report all the way around. Now, immediately there were some headlines coming out. I was like, oh, this is an anomaly report. August always has lots of seasonal adjustments. Maybe the case, but I don't think it's a report you can just dismiss out of hand saying, oh, it's a one-time anomaly, particularly given the weakness that we've seen in the prior months. Employment has been getting weaker now for the last several months. And there's been a clear trend of employment weakness over the last couple of years. And again, one of the things that analysts on the media tend to do wrong is they look at one number and they say, oh, this number, 22,000 jobs. Hey, we created jobs. It wasn't negative. But you can't look at just one number. The number doesn't tell you anything. What's important is the trend of that data over time. Has the trend of the numbers been getting stronger or weaker? Clearly, they've been getting weaker. And it's just taking a lot longer to get there than we expected, but that lag effect is now showing up. That money that we injected, that pig is now leaving the python. And all that liquidity support is now going away. And now you're starting to see the inverse of that, which is rising delinquency rates and slowdowns in economic activity. Yes, services are still slightly above contraction. Manufacturing is in contraction. So we're not seeing a huge slowdown in economic growth yet because 70 to 80% of the economy services, and that's still doing okay right now. But that also is clearly slowing down. So it's just a function of time here until we start to see weaker economic data, and that's starting to show up in the employment data. And the thing about employment data, which is most important, is not necessarily just the jobs in general, but it's also the quality of the jobs. And what you're really looking at is how many full-time jobs are we putting on the books versus part-time. The trend of full-time employment is declining. And that's what you normally see before weaker economic periods because companies are going, okay, I don't want to hire a full-time employee because A, I have to train them. It costs me a lot of money, except when I hire temporary and I can just fire them anytime. And that's much easier for corporations to control when they're unsure about the economic future. And we're seeing a lot of that in the data right now. So again, we go back to look at that employment report on Friday and looking at that data as a function, it was not a great report. That's why we also saw the markets, yes, they opened up sharply on Friday, but then immediately sold off because not only did bonds rally sharply on Friday, yields dropped slightly over 4% on 10-year Treasury yields right now. But as we talked about before, what drives yields ultimately is economic growth and inflation. Both of those are declining. And what employment shows you on Friday is that disinflationary pressures in the economy are becoming greater than the inflationary pressures. So again, all this really kind of starts to tie back into where we are, but this is the problem. Employment drives economic growth. Economic growth drives earnings, and that puts potentially the markets at risk.
Catch me daily on The Real Investment Show. The link is in the description.